A lot of us are uncertain about how we should be investing our money, and more particularly about the ideal order we should be investing our money. And this is particularly for high income earners. You might have heard pay down student loans, pay off high interest debt, save money in a savings account, use a Roth IRA, contribute to a 401k. It's all overwhelming and you don't know where to start. Well, in today's video, I'm going to break down the optimal order investing for high income earners. I'm Matt Sorensen. Let's build wealth. All right, now the first thing here, you must have an emergency savings account. We've got to get that off the table here. I know it's not sexy, but you need at least 1 month of emergency savings. And remember the purpose of this emergency savings. If you have a car breakdown, you have a job change, you have some money to fall back on. After we have that 1 month, we can get faster to investing. Now, I want you to avoid focusing on interest rate and this money working for you. Don't put it in a CD where the money's locked up. Remember, we want this to be liquid money, only a month. Get it in savings. Maybe it's a money market account that is getting a return, but don't focus on making money on this bucket. This is about liquidity. As we get down the list here, we're going to be focused on growing our wealth, but this first one, that's not what it's about. This is for emergencies and we need liquidity. Now, the second thing I want you to do is if you have a 401k at work, I want you to put only enough money in here to get the free money match from the company employer. So let's say, for example, you make $200,000 a year and the company says, hey, if you put in 4% of what you make, we'll match that and we'll put in 4% of what you make. So 4% of what you're making, 200 grand would be $8,000. The company does a dollar for dollar match on that, putting in $8,000. You now have $16,000 set aside. You can max out a 401k up to $70,000 a year. We're going to come back to that here. But for now, I want you to get the match and then get out. We want to do some other investing before we put more money into the 401k, but you do not want to pass up the match. If your company offers a 401k, this is 100% return on your money. If they're doing 100% match, which a lot of 401ks do, and you do not put money in the 401k, you're missing out on doubling your money. I'm only putting in $8,000. The company's matching that with another $8,000. I have doubled my money. Okay, you are stupid to pass up the match in your 401k. I want you to do this before you pay off high interest debt. This is 100% return on your money. Now, maybe your company does a 50% match. There are some 401ks that do that. That is still an incredible return. All right, now number 3, I want you to pay down high interest debt. The reason we want to pay down high interest debt is because it's really hard to get a rate of return on our money that we invest that is going to beat a high interest debt. So for example, if you've got a credit card where you're paying 20% interest and you've got $10,000 at your disposal, you'd be better off paying that credit card balance down $10,000 because it's got a 20% interest rate, which is costing you $2,000 a year, than you are taking that $10,000 and investing it somewhere because it's hard to get a 20% return where you'll make $2,000. So it is costing you significantly to be carrying high interest debt. So rather than investing at this point, I want you to pay down any high interest debt first. This could be credit cards or other loans that are over, I'd say, a 12% interest rate. Let's definitely focus on paying that high interest debt down first. Now, you might have student loans or other debt that's at lower rates. Of course, mortgage debt and things on assets that can appreciate, different analysis here. But let's focus on credit cards or other high interest debt that doesn't have an asset back to it that could go up in value. Let's pay that off first before we invest anywhere else. All right, now the next place I want you to focus on is a Roth IRA. A Roth IRA, you can put $7,000 a year into it. If you're 50 or older, you're going to put an extra $1,000, so you can do $8,000 a year. This is where I want the next $7,000 to go. Now, since you're a high income earner, you might be saying, Matt, but Roth IRAs don't work for high income earners. Well, you have to do what's called a backdoor Roth IRA. So if you make more than about 136 grand single, 200K married, you can't just do a regular $7,000 contribution to a Roth IRA. Roth IRAs are tax efficient vehicles. When you put money in it, you don't get a deduction, but that money, as it's invested, you pay no tax on it. And when it comes out later at retirement at 59 and a half, there's no tax on the way out. Because of that tax-free growth and tax-free withdrawal, the government said, hey, we can't let people who make a lot of money use this strategy. However, there's a loophole in the tax code called the backdoor Roth IRA. It allows you to make a traditional IRA contribution, convert it to Roth, and now you have a Roth IRA. You can do that every year. I do the backdoor Roth IRA every year. We have thousands of our clients who do a backdoor Roth contribution every year because they're wanting to build this tax-free bucket of money. Now remember, this is $7,000 a year you can put in, and we are going to invest this for long-term wealth building. Now for more detail on the backdoor Roth IRA, I've got a video here that goes into the detail, and this is specific for any of you high income earners. If you make less than 100 grand a year, you can just drop the 7,000 into a Roth IRA just like anyone else. But again, for high income earners, we need to do the backdoor Roth IRA. All right, let's take a look at where we're at. Let's say in the emergency savings account, you put $5,000 away. Let's say for now, you don't have any high interest debt, so let's just take that off the table. But we've got 8,000 you put into the 401k. The company did a match, so that's up to 16. You put $7,000 into the backdoor Roth IRA. So now we are up to $23,000 set aside investing in tax advantaged accounts. Remember, when you're making money in these accounts, the 401k and the Roth IRA, it's not hitting your 1040. It's not going on your tax return, all right? This is long-term wealth building. We're going to access this later at 59 and a half. All right, now we've still got 7 steps left to go here, but let's keep rolling here. The next one I want you to think about is a health savings account, or HSA. Now, the reason we like the HSA is it gives you triple tax benefits. I get a tax deduction when I put money in. The money in the HSA can be invested, and I pay no tax on the investment growth, and it comes out tax-free for medical. One of the biggest expenses we have as Americans, particularly in retirement, is medical expenses. So putting money aside in an HSA is something you're going to definitely want to do, at least for the tax deduction, because typically when you spend money on medical, it's not deductible. But if you're using an HSA, you get the deduction when you put the money in, whether you spend it on medical or not. And if you don't, let's let it stay invested and grow, and later it's going to come out and cover that medical we're definitely going to have in our later years. Now, you can put $4,300 if you're single into an HSA, and $8,550 if you're married, or if you're a family, this could be a child, the family HSA. All right, so I can put that money in the HSA, but don't make the most common mistake I see people do with HSAs. They literally have the money just sitting in a savings account, not growing, not investing. We need to invest the HSA. I don't care whether you're doing a brokerage account HSA, you're self-directing it here at Directed IRA, buying real estate or crypto or other private assets, but you need to invest the money. The whole purpose of growing and building wealth is putting money aside that's invested so that our assets are working for us, not our asses out working for us, okay? We need to get this money growing. The real way you're going to build wealth is not setting this money aside. It's this money investing and growing over time, compounding. That's one of the 7th wonders of the world. I think Warren Buffett said that. We need to get this money invested. Do not use the HSA, as it's literally called, a health savings account. Think of it as a health investment account. Start investing those dollars. Hey, I'm cutting in here because I want to make sure you know all the stuff I'm talking about on my YouTube channel, investing in alternative assets, whether it's real estate or private funds or private equity, oil and gas, crypto, saving on taxes, all these concepts I love and I talk about here. I want to let you know we do this at my company, Directed IRA. So get on over to directedira.com/call and book an appointment with one of our self-directed IRA specialists that'll help you understand how to take control of your retirement. Now, I want to give one other tip on the HSA that I think is really critical for those that are more advanced wealth builders. When you're putting money in an HSA, don't ever spend the money out for medical now. One of the unique benefits of an HSA is once you set up the HSA and you put money in it and you have that HSA qualifying, you can pull the money out for medical whenever you want. For example, let's say in 2025, I have some medical surgery that was $10,000. I just have to document that expense. I can still let that $10,000 stay in the HSA, stay invested, stay growing and paying no tax on the growth, and I can pull the money out in 2035, in 2045 from the HSA because it was a qualifying expense back when I had the HSA. So don't think you have to pull the money out now if you don't need it. Better wealth building strategy would be leave it in the tax advantage account in the HSA and pull the money out later on when you need it, when you're actually going to live off of that money and start drawing on the wealth in your HSA or other retirement accounts. All right, now the next step here is we're going to come back to the 401k. Now remember, we already put $8,000 in as an employee. That came off of your paycheck. That was your contribution. The company matched and threw in their own $8,000, but now you've exhausted the match. So we're coming back to the 401k now after we paid down any high interest debt, after we maxed out our Roth IRA where we have more investment options, after you've utilized the HSA. So now we have more money we can put in a 401k. You can actually put a maximum of $70,000 a year into your 401k, but let's go through the mechanics on that and how it works. All right, now the first thing to know is the maximum employee contribution you can do is $23,500. So I already did $8,000 earlier to get the match and then I got out. Now now we're coming back. So I've got $15,500 left I can put in as the employee that gets me to the $23,500. Now, we're not done yet though, because we still have more money that we can put in here. All right, now remember, the company put in $8,000 in a match, but they've maxed out. They're like, great, you put in the money, but we're not putting any more money in for you. So I've got $23,500 in. The company put in $8,000. We've still got another $38,500 that we can put in that'll get us to the $70,000 maximum amount that you can put into a 401k each year. Now, how do I get that $38,500? Well, what you want to do is what's called a mega backdoor Roth. The mega backdoor Roth is a strategy in the 401k where I can get up to the $70,000, past the $23,500 employee, past the $8,000 employer contribution in this example, and fill the gap of the extra $38,500 with what is called an after-tax contribution. Now, this after-tax contribution can get up to the $70,000. Since I already have $31,500 in the 401k so far, I've got $38,500 left to max out to the $70,000 number. So I've got a $38,500 after-tax employee contribution. You're putting this in, and you got to work with your 401k administrator to do this. Now, about 40 to 50% of 401k plans allow for after-tax employee contributions. So you got to make sure your 401k allows for it. This is becoming more and more popular, particularly as people in management and high-income earners are trying to get more money set aside. It's been made easier in Secure 2.0 and from IRS guidance. This strategy is definitely viable and is very popular for high-income earners. Now, I've got a separate video on this. Click the link over here to watch the video on the mega backdoor Roth. Now, what happens though? After you put the money in of that $38,500, you can then do one of two things. One, you can roll it out to a Roth IRA, which is what I'd recommend, or two, you can do what's called an in-plan conversion of the after-tax dollars, the $38,500, to Roth 401k dollars. Do not let that money sit as simply an after-tax contribution. It will be a nightmare and your CPA will hate you. You have to track that separately on your tax return. The whole loophole of this mega backdoor Roth is the fact that you can roll it out directly to a Roth IRA, no tax, no Roth conversion required. Or you can do what's called an in-plan Roth conversion, converting these after-tax dollars to Roth 401k dollars within the plan, no tax on the conversion, because these are after-tax dollars already. You never took a deduction on these dollars to put them in, so you don't have to pay a conversion or tax on the conversion to get it over there. But do not let it just sit as after-tax contribution dollars. Again, roll it out to a Roth IRA or do the in-plan conversion to the Roth 401k. Now, the reason I like rolling out to a Roth IRA is you have greater investment options. Now, you already have a Roth IRA. Remember, we would have set one up way back here before you even did the mega backdoor Roth 401k. But greater investment options mean you can be at an IRA where you could be self-directing, right? When you're in your 401k with your plan, you might have a target date fund, some mutual funds. You typically have more limited investment options. But when you're in a Roth IRA, whether this is a brokerage IRA or a self-directed IRA, like our clients are investing into crypto, into private companies, into startups, into private funds, into real estate, into private equity, venture capital. Like your IRA can be invested more easily into these private assets and to be invested in assets you know than you can with the brokerage IRA or, of course, typically in your 401k with your 401k administrator. All right, now the next place we want to focus is college savings. If you have kids or grandkids that you want to help with this, is think about doing a college savings account. And if you're familiar with a Coverdell, you can put $2,000 a year into a Coverdell savings account. You don't get a deduction for it, but that money does grow and there's no tax on the growth and can come out for qualifying college or other educational expenses. 529 plan is $19,000 a year and $38,000 a year if you're married. Now, one thing I like on the Coverdell is you can self-direct that. That could be a brokerage account. You could be doing self-directing on alternative assets that we do. So a Coverdell is a nice option because you have greater investment options, but you can only put $2,000 in a year per child. The downside on the 529 is you don't have many investment options. Typically, you're investing and these are your ETFs or other target date funds that the money is going to. It's government run, but you can put more money in a 529. So if you're single, you can do $19,000 a year per kid or $38,000 a year if you're married. You can actually exceed those in some advanced strategies, but frankly, for most of our high income earning clients, they're not using a 529 to help fund college past these limits. One other thing I want to throw out though that we do with a lot of our clients is a kid Roth account. All right. Now, one of the strategies we actually like to do for college savings instead of the Coverdell or the 529 is a kid's Roth IRA. You can put $7,000 $50,000 in a kid's Roth IRA. Now, they must have earned income. Maybe they've got a summer job, they're working on the rental property or in the family business, where you can justify some earned income to them. And that allows you to put in a contribution on their behalf into their Roth IRA up to the amount of their earned income, to the max of $7,000, which is the Roth IRA contribution. Now, the nice thing about the Roth IRA, and remember this for your own Roth IRA or your kid's Roth IRA, is the contributions you put in come out with no tax or penalty at any time. So let's say you have a 13-year-old and you put $7,000 a year in over the next 5 years. That's $35,000 of contributions. Let's say the account now is $50,000. So they've got $15,000 of investment returns. Well, they want to go to college next year and you want to use some of this money to help fund that college. Well, that $35,000 worth of contributions, 5 years of $7,000, you can pull out for any reason, let alone college or educational expenses. There's no tax, there's no penalty. You can do that with your own Roth IRA, okay? So the kids' Roth IRA, we love that strategy because that money can be pulled out that they put in, and the investment returns or gains can be a huge head start for them in growing and building their retirement. Now, the investment returns or gains, those don't come out tax-free or penalty-free until 59 and a half. So it's just those contributions that can come out early for any reason. Now, the last thing I want to say on college savings, this is a mistake so many people make, is put your own mask on first. Save money in your own retirement accounts. Grow and build your own retirement account before you start prioritizing your kids' college. Too many Americans raid their 401k, don't save and don't invest because they're so focused on funding their kids' college. That is a mistake. You will be broke in retirement and you won't have a retirement to even look forward to because you focus too much on your kids' savings. Once we've already gone through these first 6 steps, then we get to college savings. So don't be focused on college savings and setting money aside in a Coverdell or 529 until you first saved yourself in your own retirement and you're planning for your own future, so you actually have one you're looking forward to. All right, next let's talk about a taxable brokerage account. Here we're putting money into a brokerage account that you're using to invest in stocks, ETFs, mutual funds, other publicly traded securities. But we've already maxed out all the tax advantage accounts we can do. So now I want to get to the taxable brokerage account. Remember, you're paying taxes as you're making money in this account. You have gains or dividends on any stock that's hitting your 1040. You're paying tax on that and that eats into your returns. But the taxable brokerage account is an important piece to make sure that you have because it's an easy place to deploy into investments and it's also one that is more accessible. A lot of these other tax advantage accounts that say an HSA, you can only pull money out for qualifying medical. The retirement accounts, the 401k, the Roth IRA, that doesn't come out till 59 and a half. So the taxable brokerage account is a good midterm savings place where you can grow and build wealth, but have access to it before 59 and a half. The downside, of course, is you are paying taxes as that money is growing and as you're getting income off of it, but no penalties to draw on it when you want the money in your 40s or your 50s. All right, the next asset I want you to think about is rental properties, rental real estate, whether this is a single family, a duplex, investing in syndications, or larger commercial assets. Rental properties have been a tried and true method to building wealth. There's a lot of creative strategies you can use to acquire these. But when you're investing your money that you're saving and earning, we want to be adding in rental properties at this stage here. The rental properties are great because you get cash flow on the income. There are a lot of tax benefits and advantages to owning real estate, and that asset appreciates over time. So rental property portfolio, we've seen many of our clients. I've been a business and tax lawyer for 20 plus years that have a significant real estate portfolio, and it happens over time. We're not talking about flipping houses every day. I'm talking about buy and hold rentals where you're accumulating assets that have strong cash flow from day one and that you think will appreciate over time. And now another way to get to the rental property strategy is don't sell your home when you upgrade. Okay, maybe you buy your first home in your 30s and the next home you're buying in your 40s is a lot bigger. Well, that home in your 30s, that little 3-bedroom, 2-bath, you should hold on to that. Don't sell that. Hold on to that and make it a rental property. All right, you probably have a lower rate. You probably paid down some of the mortgage over time, and you likely get a good rental income on it, and maybe that property will appreciate over time. Every situation is unique, but think about accumulating assets. That's how you build wealth. If you don't need to sell that property to get into the next house, don't sell it. Let's let that asset sit, collect the cash flow on it, and then you'll benefit from the appreciation over time. You already have the mortgage on it. Maybe it's even a low interest mortgage. So let's not just sell the home. let's turn our old home into a rental property as we're upgrading and buying bigger properties if your wealth and income is growing. All right, next I want you to think about these other alternative assets. This could be private equity, private lending, investing in small businesses, oil and gas investments. These have a potential for a lot higher return than what you can get in the stock market, but they have a little more risk to them. So you want to make sure that you have a good foundation of investments first before you get into alternative assets. Now, a lot of our clients are very attracted to alternative assets. We have a company-directed IRA where your retirement account can invest into alternative assets. Real estate, crypto, oil and gas, private equity, private funds, all this stuff we've talked about. Like your retirement account, your IRA could even invest in that, even your HSA. But you can also be doing this, of course, outside your retirement account with your taxable funds. But alternative assets, remember, there's different categories and risk reward profiles in those. Now, we have a lot more you can learn on that. So get over to directedira.com where you can learn more about how your retirement account can actually invest into alternative assets. All right, now we're at the last stage here, so let's talk about paying down low interest debt and when that makes sense. A lot of people say you should pay off your home, focus on paying down your mortgage. I don't understand that. Why would you pay off a mortgage at a 3 or 4% interest rate? There's zero reason to do that. You're better off investing your money in an asset that can get an 8% or 10% or even a 5 or 6% return than you are paying off that mortgage at a 3 or 4% rate. But if you've exhausted all these things, you've invested the money properly, you're focusing on getting returns and building wealth, let's now finally at the end of the day look at whether it makes sense to pay off low interest debt. Maybe it's a student loan debt, maybe it's mortgage debt, whatever it may be. Pay down that student loan debt only after you've gone out and invested those dollars. All right, now the number I think that makes sense is debt below 5%. I'm not really focused on paying that off. If you want to, if it gives you some psychological benefit to saying I have no debt, great, go do that. That'll make you feel good. But I'm just saying from a dollars and cents standpoint, it makes more sense if you have 100 grand to go invest that 100 grand and maybe get an 8% return on it than it does to use that 100 grand to go pay off debt that's at a 4% rate. Why would you go do that? Okay, you're actually going to lose money over time by making that decision. But if it's psychological and it's meaningful for you, knock yourself out. We're at the final stages here. You can go and pay down that low interest debt. Now, I know we just went through 10 steps there. Do not get overwhelmed though, okay? Just focus on what you need to do next. If you're just getting started, focus on getting 1 month of savings. The next thing, go do the 401k and get the match. Then worry about the Roth IRA. Okay, don't worry about everything. Just worry about what you need to do next. But that's the point of this optimal order of investing. Using these tax advantaged accounts that provide benefits to growing and building wealth over time. Now, I've got a free downloadable guide. Click the link below. You can download that. I outline these steps you can take. You can help use that to build a roadmap for your personal situation on how you're going to grow and build wealth. And please, lastly, make sure you're subscribed to my channel. I've got so many videos on saving taxes, protecting your assets, and building wealth. I'm Matt Sorensen. We'll see you next time.